Welcome back to the Better Policy Project. I'm Salome, a Level 1 student at the Global Forecasting School. Joining me today is Sopio, the lead author behind our latest monthly update of the Global Economy and Risk Assessment Report, also known as GERA, G-E-R-A report.
Hi everyone. At the Better Policy Project, our mission is clear. We exist to elevate economic and financial literacy across every level, from university classrooms to senior central bank governing councils. When policy institutions rely on uncalibrated black box models, the resulting errors cause real human hardship and excess unemployment. We take our responsibility to the public seriously, and we have a lot of fun taking on these big macro questions.
And before Sopio shows you why the global economy is currently operating on borrowed time, do us a favor. Hit that like button right now and drop your toughest macroeconomic questions in the comments below. If your scenario challenge pushes our analytical framework, we will feature and answer it in our next video. Sopio, in our full deep dive podcast, we unpack the 14 million barrel daily petroleum deficit caused by the Strait of Hormuz conflict. Under historical precedent, a supply disruption of that magnitude triggers immediate gas lines and a severe synchronized global recession. Yet financial markets and headline GDP numbers are humming along as if nothing happened. Why?
Because of what we quantify in the GERA report as the invisible suspension system. The global economy has temporarily absorbed this massive physical crater through three finite shock absorbers. First, pre-existing global surplus. The oil market entered this shock with an estimated 2.5 million barrels per day supply cushion, unlike the 1 million barrels per day structural deficit ahead of the 2022 Ukraine invasion. Second, aggressive global stock drawdowns. Strategic reserves and commercial inventories were liquidated at 4.2 million barrels per day in Q2 and another 3.8 million barrels per day in Q3. And finally, deliberate Asian demand restraint. China actively stepped out of the international spot cargo bidding war, drawing heavily on domestic stockpiles and curbing refinery throughput.
Look at Japan as the textbook example. Japan imports the overwhelming majority of its petroleum directly from the Persian Gulf, yet Japanese manufacturing PMIs remained in expansion. But as you emphasize in GERA, this dynamic is a two-stage cliff, not a gentle slope.
Precisely. That is our case A, nonlinear supply shock transmission. In stage 1, drawing down localized tanks cushions the blow. But once those tanks reach operational minimums, the dynamic flips from an accounting drawdown to a hard physical wall. You cannot run a steel mill, a chemical plant, or an electric grid on a promise of future delivery.
And this physical supply strain is colliding with sharply divergent central bank realities. What did Chair Kevin Warsh's first Federal Reserve press conference signal to the Treasury market?
Chair Warsh initiated a deliberate pivot away from rigid forward guidance toward raw, data-dependent price discovery. Following the rate announcement, the Treasury yield curve bifurcated, 2-year yields dropped, while 30-year yields surged. The front end is pricing near-term disinflation, and the structural investment floor created by AI data center capital expenditure. But the long end is pricing persistent supply chain frictions, sovereign fiscal deficits, and term premium uncertainty.
Meanwhile, across the Atlantic, the ECB doesn't have an AI tech boom to balance the ledger.
Europe is locked in a classic stagflationary bind. Euro area growth is propped up on fiscal life support, namely government defense and infrastructure spending, while underlying private consumption flatlines. With maritime rerouting around the Cape of Good Hope surging to 9.4 million barrels per day and energy import prices up over 20%, upstream producer costs are spiking. The ECB may be forced to raise its deposit rate toward 2.5% to prevent second-round inflation, even in a stagnating economy.
And China is caught in a two-speed trap. Chinese PPI has jumped to 3.5% from raw import costs, while domestic CPI sits near 0.5% because consumers facing an 18% collapse in real estate investment simply refuse to spend. So, Pio, you've recently achieved level 1 and are advancing through level 2 at the Global Forecasting School. Our mentor, Douglas Laxton, constantly reminds us that there is a multi-billion-dollar forecasting industry still using static econometric models or blind DSGE black boxes with zero forward-looking economic intuition.
Doug developed forward-looking monetary policy models decades ago at the Bank of Canada and the IMF. But he always credits his mentor, Bob Ford, for the core philosophy of the Better Policy Project. Bob used to tell Doug, "Macroeconomics is like trying to roll a square ball uphill. You will never make the ball completely round. But our job as true economists is to shave the sharp corners off so that we can at least get it rolling."
And remember Bob Ford's profound answer when our colleague Anna Jolly asked him to distinguish a good economist from a terrible one? A bad economist dives into complex models and immediately gets lost because they never ask why they are doing what they are doing. A great economist dives deeply into the data, understands the structural story, and never forgets that our analytical work is meant to prevent costly policy errors and protect human livelihoods.
That is the DNA of GERA. We don't model to show off fancy Kalman filters or uncalibrated math. We build expectation-driven, structural frameworks to give policy institutions genuine foresight before the real-world buffers run out.
If you want the complete quantitative breakdown, including el-Mandeb chokepoint shifts, sovereign bond auction fragilities, and the full multi-country scenario matrix, make sure to listen to our full deep dive podcast.
You can find the direct link to the full podcast audio and download the complete August 2026 GERA report PDF on our website at www.thebetterpolicyproject.org or via the links in the video description.
Help us advance financial and economic literacy worldwide. Like this video, subscribe to the channel, and leave your macro scenario questions in the comments below. See you on the next deep dive. Welcome